Good morning. Today is Friday, the 13th of January, and it's a bit of a red day today. We have Delta stock down about 5%. You have some of the bank earnings coming out as well. JP Morgan, Citigroup, Wells Fargo, and
United Health.
Bank of America.
Thank you.
And we also have United Health as well. It's a bevy of earnings reports. We're kind of into it right now. We do get Goldman on Tuesday. A quick programming note: on Tuesday, we will not have a morning market call, but we will have the macro presentation. You should have received an invitation. If you have not received an invitation, please let us know either in the chat or on email. Happy to give you one on those. We are doing it simulcast online and in person. We obviously love to have you in person, but we understand that many of you do not live nearby. So invitation is free, open to anyone, bring a friend. It should be a fun time. We're going to do it a little bit later. This time starts at 5:30, should run about 45 minutes, then 15 minutes of Q&A. It'll be a good presentation. I think it'll be a little bit optimistic. And Tom, that leads right into what Jeffrey Gundlach said a couple of days ago in his Just Markets webcast. And he said that last year things were just tough because the Fed was behind the curve. Inflation was starting to get out of control, and the Fed was going to have to raise rates aggressively and therefore impair risk assets, both stocks and fixed income. And to his credit, he was largely right. He changed his tune a little bit now, saying that the market's not pricing into nearly as many Fed rate hikes as the Fed thinks that they're going to do, or the Fed says that they're going to do. And he says the Fed's always going to be wrong, and so you might as well just go with what the market's saying. And he thinks that the Fed is probably going to ease off some of their rate increases as inflation comes down. He says that inflation is coming down rather aggressively, and he says that it's an extremely exciting time. He's very bullish on fixed income, says there's a lot of opportunity there, and he's even cautiously bullish on stocks. Now, he does think that we're probably going into a recession, so he's a little bit nervous from that standpoint, but he does not think it's going to be severe. Credit spreads are pretty tight, so that's good for the bulls. And on the home ownership side, he says there's so much equity in the homes right now that we just have to have a massive, massive crash in terms of pure pricing to actually get any sort of credit event happening on mortgages. So he's bullish on mortgages as well. So Tom, talk a little bit about that. It was finally an optimistic tone. He said it's the most exciting time that he's had in the last 10 years.
I mean, I definitely agree with him. This is the first real fixed income landscape where we can really make money on bonds without really having to take a lot of risk. And he made some good points, particularly in the mortgage space, which is saying that, you know, mortgages really aren't AAA. We learned that in 2008, but where they really ride now with all the changes they've made in terms of credit quality and making sure that people can't afford their homes is that we're probably, you know, in that high single, maybe low AA space in terms of credit quality on mortgages. And if you factor that in and compare them to corporate bonds, there's tremendous value there. And I think he's definitely right on that. I think that really across the entire fixed income landscape, you're seeing value for the first time in spots you haven't. And in fact, you know, some of the places where we've had to kind of huddle and hope for yield over the last few years, like, you know, taxable munis or even, you know, short-term tax-free municipal bonds are not nearly as valuable as things like treasuries or corporates or mortgage-backed securities for the first time really ever. And if his scenario plays out, which is essentially that the Fed's probably going to raise one, maybe two more times, and then probably put us into a recession and have to start cutting rates. And his expectation is the Fed is going to jump on board and ease again. Should there be any sort of slowing of the economy, then you're going to be in an unbelievable position in mortgages because those things are going to fall like crazy. They're going to go back to levels we saw kind of during the pandemic, or at least pre-pandemic. And if you get back into the 4% range, we're going to see a lot of big upside on asset backs. And I think that's a way to really play this market. And so, yeah, that's something we've added to sort of sporadically over the last 6 months. It was a little touch and go there. You know, we had the big CPI scare kind of in May. But I think that's a space we'll continue to start to dribble into over the next 6 months. And if we do see a pullback, then we should see some great upside there.
Yeah, I agree. I think that it, you know, as I was building the macro presentation, really combing through the data, and looking at what sentiment was and looking at the underlying trends, I was very encouraged by how quickly inflation has come down. We talked a little bit about the last macro and the time before that, that one way that you can get out of this loop where the Fed hikes to slow the economy, to slow inflation, and continues to do that, is inflation begins to come down on its own, I guess, and rapidly. And thankfully that's starting to play out, and that is a cause for optimism. The banks reported this morning, and as I noted, they are down a bit. Primarily, it seems like they're giving a cautious view on the next year. Just giving a quick run through. I don't have my notes ahead in front of me, so I'm just going from what I did as over the last couple of hours as I've been reviewing the bank numbers. JP Morgan, leading off with them, Jamie Dimon, who has really been trying to make macro calls for the last year, really, 6 months ago, talked about there being a hurricane coming and that it's right out there. And then last quarter, he said these headwinds are immediate and severe. And this time he talked about there are headwinds, but he says that, we're actually doing rather okay and we'll be ready for whatever happens. So it was a much more sanguine tone. When you look at Bank of America, they just spent a few slides talking about how good credit quality is relative to pre-pandemic levels, and they do expect some normalization, as does Wells Fargo. But in general, it seems like people are trying to control what they can control. JP Morgan's continuing to invest in their business. Their expenses are going to be up in the mid-single digits next year as they continue to spend on technology and investing in their business. And I think that's probably their primary driving factor of why the stock is down today, is because that expectation for expense growth is relatively high. But then if you look at Citigroup's a very interesting story to me. The stock is performing the best right now. It's down, but only ever so slightly. I think Citigroup is not good. That would be my opinion. They were very much helped by some of their trading revenue, especially on the fixed income side over the last quarter. But they also basically bought deposits. If I look at the rates they're paying on deposits, Citigroup is in another league from their competitors. You have Citigroup, because deposits are the cheapest cost of funding, they're very attractive to banks. And if you have a great bank and a great franchise, you can attract those low cost deposits relatively easily, and that gives you a competitive advantage. And so I was looking through the numbers and I saw Citigroup actually grew deposits. A lot of the banks saw declines in deposits as people shifted to CDs or higher yielding instruments, or actually spent down some of their checking account and savings account balances, but not Citigroup. Citigroup actually had a 1% increase on a year-over-year basis in terms of deposit growth. I was looking into why that might be the case. And that is because Citigroup now pays 2.1% on their deposits, up from 1.2% last quarter, an increase of 90 basis points. JP Morgan was the next most aggressive, and they only increased it 60 basis points. Wells Fargo's only paying 0.46% on deposits. They're paying a quarter on deposits that you get at Citi. So Citi is getting really aggressive and trying to find some capital, find some cheaper capital. And it looks like they're having to pay up for deposits. Do you think this is a good strategy, Tom, long term?
I think it is, because at the end of the day, these banks are going to have to start paying more on the deposits. And to be the first mover and to get those deposits first, you're probably going to not have to overcorrect later, right? I mean, the federal funds rate's at 4.5%. If you got money in the bank, like, you should expect to be paying more than 60 basis points or 1.2 basis points. Or 120 basis points on your deposits. And Citigroup, I think, is making the right move. They want to get more market share. The way to do it is to pay a fair amount of interest on your checking and savings. So I think it's in the short term, it probably hurts their net interest income, but I think in the long term, they're going to be better off, because if rates stay high for a long time, people are going to be gravitating towards making more money on just their cash.
That's a very interesting perspective. I was not thinking that would be your response. Because I would actually take the other side of it, but I think that you bring up a very fair argument, and I would definitely have some sympathy to that argument. I think I'm definitely jaded by the fact that Citigroup has been a pariah for my entire career over the last 6 years.
They stink. rhymes with is a great one for Citigroup. But I think it's a good strategy. I mean, I think about that too with my own checking accounts. Like I sit here and I rotate through people's cash balances on the fixed income side. You can buy a 6-month treasury right now paying 4.8%. I mean, that's unbelievable money for zero risk. How come you can't put that in a bank account and make at least 3/4 of that? Because it's not that much different. They're just investing in treasuries to create that revenue. So I think this has to be a trend. I think people are starting to get a little antsy about why checking and savings accounts don't pay anything. And I don't think it's fair that they don't. That's the rate environment. Rates go up, you should get paid more on your deposits. And I think Citi's going to attract a lot of eyeballs doing that.
That's what makes the market. If you look at shifting gears a little bit to more defense stocks, this might impact some client portfolios. We do own some defense stocks. We own a decent amount of Raytheon, some Lockheed, some Northrop Grumman. All three were downgraded by Goldman Sachs today, and quite aggressively. Basically, Goldman making the call that things are going to get tighter at the federal government level. Defense spending is not going to go up very aggressively. And they cut Goldman's Lockheed's price target from $388 to $333, and the stock trades at $430. This is a very bold call by the top tier analyst in the space. Whenever Goldman makes a call, that market moves on that. They also downgraded Northrop to sell, and they downgraded Raytheon, which has a more robust business because of its commercial division. They had it at conviction buy, and they downgraded that to neutral. $105 price target. Stock trades at $100, so a little bit less aggressive on Raytheon. But Northrop and Lockheed, pretty big cuts by a top analyst, and all predicated on the lack of borrowing capacity at the federal government level. Do you think that this will have an impact, Tom, in terms of where interest rates are, the federal debt now, and not even so much in terms of U.S. government defaulting, but more, I guess, for lack of a better term, budget discipline at the federal government level? Do you think this actually has an impact, the current debt levels and current interest costs?
I think it does. I mean, when interest rates are zero, we saw it in 2020 when we, did $2 trillion in stimulus and raised all that money at super, super low interest rates. The interest costs of the U.S. government actually went down because you're replacing old bonds that are paying, higher interest rates with new bonds. And even though it's more of them, the interest rate is so low that it didn't really have much of an impact. But now coming out of that, we can't just be firing into anything we want to in terms of a budgetary item. You can't just be like, oh, we're just going to throw, hypothetically $110 billion at Ukraine without there being any consequences, because instead of having to pay, 0.009% on your, 2-year treasuries, now you're getting, close to 5%. And you got to pay that. And so I think that that's something that needs to be taken into account. And I think that is probably a good point that, we can't just endlessly spend anymore, because interest rates are at a level where it starts to really add up very quickly, where it was not adding up that quickly before.
On the consumer level, JP Morgan is talking about cash buffers for the consumer coming down to pre-pandemic levels by the third quarter of this year. What's notable about that is they were also saying that would come down to pre-pandemic levels by the third quarter of last year. And the reason for that is real average hourly earnings. And again, we'll talk a little bit more about this on the macro presentation on Tuesday night. Real average hourly earnings have begun to improve. They're still declining and savings rates are still going down, but you've seen the trajectory start to flatten out. And that's all because inflation is beginning to come down. And so the more we can get inflation down, the more we can push out that time where we exhaust the savings buffers. And according to JP Morgan, right now, that's the third quarter of 2023. So we'll look for hopefully further push outs of that if inflation comes down faster. So that whole mechanism that we came out with in Q2 is still in place. The question is, how long does inflation drag on people's incomes, and how quickly can we get that down? So with that, we will leave it there. There is no call on Monday, no call on Tuesday. The macro presentation with the outlook for 2023 will be Tuesday evening at 5:30 online and in person at the Brick and Board in Marietta. Hope to see you there. Thanks.